QuickBooks Online 2025, entering sales receipt forms as though making sales at a cash register, followed by a deposit form as though taking that cash from the cash register, putting it into the bank in one lump sum. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are in our QuickBooks Online Get Great Guitars 2025 Project 5. We set up in a prior presentation, opening the major financial statement reports, which are located, of course, on the left-hand side. We're in the standard reports favorites section. Right-click it on the balance sheet to open a link in a new tab. Right-click in the P&L, otherwise known as the profit and loss or income statement, also opening that link in a new tab. Let's tab to the right and close up the hamburger. We're in the modern view mode, selecting the drop down so we can see the custom date range because I want to make it go to a 2-month time frame, going from 01/01/25 tab 02/28/25. Let's say it refreshes automatically. Let's go to the display, select the drop down and transaction dates. We want to see it months. So it has side by side January and February of 2025. Let's tab it to the right and repeat the process. Closing the ham boogie. Scrolling up to the custom dates tab. We're going from 01/01/25 tab, 02/28/25 tab, display, drop down, dates, and months. Boom. Close it up, and there we have it. So we're continuing on with the second month of operations, that being February. Let's go back to the balance sheet. This time we're going to imagine that we're making a sale at the cash register. Remember, what we do here is we sell guitars, and we imagined entering an invoice versus this time being at the cash register. So if I select the drop down, if someone wanted us to order a guitar, for example, and we don't have it in the shop, maybe we would buy it and then possibly invoice them for it and then ship it to them, possibly in that process, the invoice increasing the accounts receivable. But if they come into the shop and they just pick up a guitar at the shop, we can imagine that we're at a cash register, in which case we're not going to enter an invoice. We're going to instead enter a sales receipt type of transaction, that being the transaction when we get paid at the same point in time we do the work. Let's do a quick look at the flow chart over here. This is a QuickBooks desktop flow chart, but we're using it for online purposes because we just want to look at the flow of the forms, okay? And this is a good flow chart. So if you have an invoice, we're going to invoice the client. Usually you're thinking of like a service business when you're thinking about invoicing, although some types of inventory businesses would use the invoice as well. It's going to increase the accounts receivable if we do the work first, and then we have to bill the client. But if we're in a store situation, then we're going to get paid at the same point in time. This would happen like at a restaurant, for example, or any kind of store where you're picking up the item, bringing it up to the cash register, or possibly checking it out yourself, like at a grocery store or something like that. Now, if you had a very simple business and you're like, hey, look, I don't want to deal with maybe not even tracking the inventory, doing the inventory off on my own on a periodic system, and I just want to have everything go through the bank feeds, you could try to say, I'm just going to make the sales, collect the money, wait until it clears the bank, wait till I actually deposit it, in other words, or wait till the credit card companies deposit it into my account, use the bank feeds to record the revenue as a deposit. Now, the problem with that, however, is that you don't have the beautiful internal control that you would like to have when you have especially multiple people at a cash register, because you got to make sure they're not ripping you off. Even if they're family members and stuff, you get some crooked family members in there, man. You think you don't need an internal control, and you're like, oh my goodness, they've been ripping me off like this whole time. So you have to basically want to check the sales on the cash register compared to the actual cash or sales that were made. In order to do that, you want to enter it as basically a sales receipt when the sales are happening, and then either you're collecting cash or you're getting paid in some other way as well, which might be by credit card, for example. And then at the end of the night, you're going to take that cash and put it into the bank, not sale by sale, but in one lump sum. and therefore we put it into the bank in one lump sum. That will tie out to what is on the checking account in the bank side of things, helping us to do the bank reconciliation. Now, entering the sales receipt form also allows us, if there is inventory, to track the inventory on a perpetual inventory system, recording the decrease in the inventory and the cost of goods sold, as well as the subledger recorded by units, as well as deal with any sales tax, a type of consumption tax, at the point in time we create the sales receipt. So that's what we're going to do here. We're going to go back on over and let's do it. Let's go to the first tab. Stop talking, man. Get to doing. I want to see. I like doers, not talkers. Okay. I'm going to hit the plus button. I'm going to do it so you like me because I want to be liked. I want to make sure I go into the sales receipt form, not the sales order form. So we're in the sales receipt form. We have to enter a customer, noting that if you're at a cash register, you might not actually be entering the customer information because you don't need that information in order to send them an invoice. And for example, if you go to like a McDonald's shop, you're ordering a burger, you don't typically want to give them your contact information. So you might just have a generic customer in that case. But we're going to type one in, Garcia Guitars. Now, I've already added this one. If it's not in there, which it won't be because we haven't done it yet, then you would add the new customer here. And then all we need is the required field on this side. But I already have it in here. I'm going to select Garcia Guitars. We don't need the email address unless they want to provide that, because we're not going to be emailing this to them unless they want us to do that. We're going to put the date on 02/20/25, if I can get the date correct this time. This is a sales receipt form populating automatically. So we'll keep the location. It's going to help us calculate the sales tax or consumption tax if that is applicable. We're not going to have any tags. The payment method. Now, this is where they might be paying us by cash. They might be paying us by credit card. Depends what kind of methods we allow to pay us in. Now, if it was an electronic transfer, which is less likely to be the case, but possibly more and more likely these days at an actual store, then we might put it directly into the checking account over here because we're not going to have any grouping problems. But if we have any other kind of collection method, such as we allow them to give us cash or credit card, then I possibly don't want to put it directly into the checking account because I'm going to have that grouping problem of it going to an intermediary state, that being either in the cash register or it's occupied or held by the credit card company. And that means when it hits my checking account, they're going to group it together. So I'm going to imagine just it's cash because that's easier to visualize what the problem is. And then instead of putting it into the checking account directly, which means if I did that, I would have, instead of a deposit form, increase to the checking account with sometimes a sales receipt form, but it's not going to be deposited in the checking account, possibly in just this one sale that I'm going to make. That's why I have to use the clearing account, which is going to be the payment to deposit, so I can group the payments together, depositing them in the checking account in the lump sum that will be equivalent to what's on the bank's side of things, allowing me to the bank reconciliation, possibly with the help of the bank feeds. So we're going to tab through here and we're going to say that we're going to get an EPSP. So we're going to save, that's going to pick up that one. And that's an Epiphone Standard Pro. Okay, we're going to imagine we have 6 of those on hand. It gives us a nice little thing here. We're going to sell 2 of them. Now, this is going to be the sales rate, not the cost. So that's going to be how much we sell them for. This would be similar to if you did a self-checkout at a grocery store. It's going to give you the sales price, but also it's tracking the cost of the units. Sales tax is going to be applicable as per what we entered for the sales tax based on our location. We're going to have an ELP as well. ELP, let's say. So we imagine they came up with this other guitar. And it's so easy to do the data input. Even that stupid teenager, he's not stupid, but he's this teenager sleeping under the desk, half asleep. He's able to get up and enter it in, even though he doesn't know what he's doing. He doesn't even know where he's at. But that's how easy it is because we set up the items properly. So now that comes out to 2,200, and the teenager's like, dude, the 2,200, and then the sales tax. Now I'm going to change the sales tax to the generic 5% for our practice problem purposes, because that's what we're doing to make it kind of generic to see how the consumption tax would work. And there's going to be our transaction. So what is this going to do when we record it? It's similar to an invoice, except instead of increasing the accounts receivable, it's going to increase not the checking account, even if we got cash, because it didn't go into the checking account yet. It's going into the clearing account. We're going to have it in our cash register, and we're going to have to keep tabs on it and put internal controls in place, particularly if you're located like where I'm located, because there's thieves all over the place. The place is crazy. Like you step like right outside your door. There's crooks stealing stuff. It's madness. So what you got to do is do the internal controls, make sure that you got it in the cash register, you get all the money together, and then you get the bouncers and whatnot, and you take it to the bank and try to, get there without getting robbed. So that means that we're going to increase undeposited funds. The other side for the full amount, including the sales tax, $2,310. The other side's going to be going into revenue for just the sales amount, which is going to be the $2,200. And then the difference of the $110, just like with the invoice, is going to be increasing a payable account, sales tax payable. And because we sold inventory, the inventory is going to be going down, not by these dollar amounts, but by the amounts of the cost of inventory, which is driven by the items that we entered into the system. And the cost of goods sold is going to go up for that same amount. The net impact on net income is going to be $2,200, the sales price minus the cost of the goods that are sold. Also, we have the subledger account for inventory tracking not only by dollar, but by unit, which will be impacted as well. Let's save it and close it. Check it out. See if that is indeed the case, or if I'm lying to you. Am I lying to you? No, I'm not lying. I'm just too stupid to know what actually happens. No, I'm not. No, I do know what's happening. I'm not lying or stupid. Okay? Let's hit the drop. I'll show you. I'll show you what I'm talking about. I'll show you that I know what I am doing. People still don't care. You show them that you know what you're doing, and they still were like, we're not doing that. It's like, we'd rather go out of business. We'd rather the country falls into the pit of hell. But I showed you it works this way. Why won't you just do why? We're not going to do that because we don't like you. Let's go into the sales receipt. And so there it is. It's going to be the 2,310. See? You see? I'm telling you, I know what I'm talking about. Whatever, dude. We're not doing what you say because you're stupid. I'm not stupid. I'm telling you. Look. I'm showing you exactly what I'm saying is true. 2,200. If I go into here, it's in 2 line items, posting each of them, not including the sales tax, closing that out, and then go back. And then I'm going to go back to the balance sheet, and then we'll scroll down to the sales tax payable. That's the difference. We have to pay this to the government. So they help us. They're supposed to protect us. We have to pay the protection money to the government, but they don't protect us. The thugs are right outside your door still. It's ridiculous. Why don't they do something with the money so people don't be robbing people? I swear, it's crazy, man. Anyways, then we've got the inventory. If we go into the inventory, we've got the sales receipts on the inventory, which is going to be for the amounts that are not actually on the sales item because it's the cost, but it's driven by the item. Notice there's 3 items here for the same invoice, and that's because it's trying to track the units in a first in, first out flow assumption method. So you might wonder why it breaks it out that way. I think it's trying to figure out the layers that are impacted in a first in, first out method. Let's close this out. What did I do there? Okay, I don't know. It's okay though. Let's go back and then, so let's go back to the income statement one more round. We've got the cost of the goods that are sold. Boom. Net impact on net impact is the sales price, not including sales tax, minus the cost of the goods that are sold, going back to the first one and noting that we also have the inventory that we need to track by units. Let's open up an inventory subledger account. First tab, going down to the reports on the left-hand side, closing out the hamburger. I'm going to go down to the sales area. We have the inventory valuation summary. Open in a new tab. Por favor, please. And so we're going to close that out. And as of today, that'll do. That'll do. So we have 25 units of all these units. We've got the value at the 79,738, which should match what's on the balance sheet. 7938. Is that what I said? 7938. Yeah, it's not what I said, but that's what I should have said. Now, we also can see this on internally. If I go to the first tab and open up the ham boogie, and we go down to the sales area, closing the ham boogie, we don't need to be in here as much because I don't have to track people down. That's the beauty of having a type of business like a restaurant or something where it's a pain during the day. You're in there trying to make people happy, but at least you don't have to try to collect money for the service that you did last week, tracking the accounts receivable. They pay you as it happens. No payment, no food. No payment, no food. You can't do that if you're like a bookkeeper or something. You have to deal with clients that stiff you. So let's hit the drop down and we're looking for the sales receipts. Boom, sales receipts. We can look at them this way if we needed to. We can also go to the customers up top and we can check out that new customer. Now, if we were tracking by customer, we could find the customer, or else we would just have that generic customer. What was it? Garcia Guitars? Garcia Guitars. It's catchy because it's got the 2 G's in it. It's alliteration. Alliteration. There it is. There's the sales. Okay, let's do another one. Let's do again. So someone else comes into the store and the teenager, the half asleep teenager at the counter is like, "Oh, dude, what, do you need a guitar?" And he's like, "Yeah." And so we go to like the sales receipt. "All right, dude, I'll enter the guitar for you. What's your name, man?" And he's like, "It's Anderson. I'm a repeat customer." So, "Oh, I remember you, dude. Mr. Anderson, you're famous. Do you like, let's go through here. Okay. It's going to be on 220 again. Okay." And so then the store location, and then we're going to do the same method, and we're going to imagine it's cash because we want to do that intermediary deposit where we can imagine we deposit it. But remember, you have the same problem if you're getting paid by anything that has an intermediary, like a credit card. It's only if you get cash. But if you get like a check that goes directly into the checking account or a transfer. But even then, if you also receive credit cards, you possibly want to put it through the payment system here. So I'm going to imagine cash. And so we're going to grab the cash. We got a lot of cash on us. We got to be careful. I'm not sure the dude at the desk can hold back the crazy thieves outside the door. So we got to make sure that we take that cash to the bank periodically so we don't have a security risk. All right. So let's say that they brought up a DUK, which is a ukulele. It's like, "Oh, ukulele, that reminds me of like Hawaii, man. That's cool. Do you know how to play a ukulele?" And so that's going to be 64. And then just ring it up, dude. Just ring it up. Okay. What else do we have? It's an EPR, is it? I'm trying to read my notes here. EPR, Epiphone Rivier. That's a cool one too. I played that in the store just a little while ago. It's one of the perks of working at a guitar shop, man. That's great. Okay, let's look at the next one. It's a GIUSA. Oh man, that one's made in the USA. That makes it special. It's not subject to tariffs. All right, so that's going to be 2,094. Let's hit the drop down, and we're going to put it at 5% on our standard tax rate. So what's this going to do then? Once again, it's going to be increasing not the cash, not the accounts receivable, but the payments to deposit account, because we're imagining it's actually in our check register, not in our checking account. It's not safe there with all the crazy people around here. So if we don't put that into the bank, we're making the teenagers in danger. We got to put it in the bank, man. So we're going to say that's going up for 2,198.70, including the sales tax. The other side's going into revenue, not including the sales tax, 2,094. The difference of sales tax, 104.70 is going into the sales tax payable account, a liability account. And we know that the inventory is going down not by the amounts here, but by the amounts known by the system due to the items. And the cost of goods sold expense account is going up by that same amount. The net impact on net income is the sales price here minus the cost of goods sold, and the inventory subledger going down not only by dollar amount but by unit. We'll be tracking those units as we go on a perpetual inventory method. All right, so let's go ahead and save it and close it, and then we'll check it out. So let's go on over to the balance sheet and see if I said it correctly. Again, I know I did, but people don't believe me. I was like, I have the receipts, man. I have the receipts. We still think you're wrong. But it's like, dude. Okay, there's Anderson. See, it's for the 2,198. 2,198. There it is. I'm going to close that out, and then I'm going to go back. And then I'm going to go see, and then the other side, if I refresh it, goes to the profit and loss. It goes into the sale of product income right there, just like we planned it to. Here's the sales numbers. It's going by item because it's tracking like the inventory and whatnot, or each item. It's not including the sales tax. And then the sales tax, closing that out and going back, is the difference that's on the balance sheet. See? It's over here. See? It's right there, just like I said it was. And then it's going to go, so that's the sales tax that we're going to have to pay to the government for their protection money, or else they beat us up with penalties and interest and throw us in jail. But then they don't protect us, which is lame. They should protect us if we pay them protection money. And then the other side, though, is going to go into the inventory. We're going to go into the inventory. And so that's going to be then Mr. Anderson. It's going to have 4 of these because it's tracking the first in, first out layered inventory system. Let's go back. And then on the profit and loss, we see it's right here, recorded right there. See, right there. I have the receipts going back. Just like I said, we still don't believe you. We think you're wrong. Why? How could you possibly say... we're not doing it that way. Okay, so here's the inventory subledger giving us the units of inventory and the total dollar amount, 6,266, which ties out to what's on the balance sheet as well, 6,266. We can see internally if we wanted to track it internally, which we don't need to because we're not really tracking, we're not having to collect on the items, but we can go to the all sales transactions and once again look at those sales receipts. Or we can track it by customer if we're entering the customer, if they don't get pissed for us asking the customer information, because we want you on our email list. What was the customer's name that time? I forgot. Who was the Anderson? That's a repeat customer. How can you forget Anderson, dude? That's like the main dude keeping us afloat. All right, so now we're going to imagine at the end of the day, we need to take the bank deposits to the bank and put them in the bank because they're in the cash register, and we got crooks, we got thieves all over the place. So the more money, if it gets out that we have all this cash on hand, that's when the crooks will break down the door. They're always threatening to break down the door, and so this is like when they will do it. So what we have to do is we have to make sure that we deposit like at the end of the night to the bank, and we have to close the store out earlier these days because it's not safe out there these days. So we got to close it early so it's still light out. And then we get our bouncers and stuff so that we can walk to the bank and we're going to make the run. So we're going to go to the bank deposit and make the run to the bank. We're going to put it into the checking account. same date, 2/20. And notice it's populating automatically down here. These are the ones that are generated from the sales receipts. If we had the receive payment forms, they would be in here as well. And we're going to group them by the payment method. So now we have these two that are cash. They're in the cash register. So those are the ones that we want to be putting into the bank. If we put them together, we're going to make a one lump sum deposit. I'm not going to make two deposits for these two amounts. And therefore, if I put these directly into the checking account for two amounts, then I'd have to do some finagling, some combining together when I do the bank reconciliation, possibly with the help of the bank feeds, because the bank feeds would show it as one amount. You see the problem? So we're going to put it in there as one amount into the checking account. Now, if it was a credit card, we might also have like a bank fee that the credit card took from us. They're going to take our money, but they're going to give us a service. And it's actually safer these days to use the credit card, even though they might charge us, because then, you know, they're less likely to rob us than the crooks, you know, with the cash. Cash is risky business, man. Risky business. All right. So this is going to be increasing the checking account by the 450870, and the other side is going to be decreasing the clearing account, which is the funds to be deposited. So in essence, if I go to the balance sheet, we're taking it out of the clearing account, this account, putting it into the checking account. Let's see if that's not what's happening. That's not, it is what's happening. It's what's good. I'll show you. I will show you. Why don't you believe me? Well, let's save it. I'm telling you. Let's go over here. You should listen to me. I know what I'm talking about. Watch. If I go like, see, it goes into the checking account. This is how you do it. This is how you should do it. Why don't you do it the way I say you should do it? See, it's going to be right there as one lump sum. That's the amount that's going to come through on the bank account so that we can check it off when we do the bank reconciliation. That's why you do it that way. That's not how we're going to do it. And then the other side is going to go into the payments to deposit. Now, it won't let me click on it. So one way you could get there is you could go back to the old view option. Where's the old view? Switch to classic view. There might be an option that we can click on the zeros in the new modern view. But for right now, let's just go into that payments to deposit because we're running along on time and I don't want to waste your time. See, we have the increases and decreases. It went in here as two numbers instead of one number, which is great. QuickBooks is really good at this because it allows us to tick and tie the increases as well as the decreases. If there's a problem with undeposited funds, which is now called funds to deposit, this clearing account, which there often is, if people are not experienced with this account, they will mess it up almost inevitably, and then we'll have to fix it. But that's okay. That's what we do. We know how to fix it, and so we fix it. All right, that's going to be, this is where we stand as of this point in time. Here's our balance sheet accounts. If you want to check out your numbers, here's our profit and loss, otherwise known as the income statement. We're currently, do we have any income yet in the current month? We do have some income, some net income that is. Let's also open up the trial balance, which I think first tab is the best report to look at to check your numbers. Let's close up the ham boogie so I have some elbow room, and we're going to put in trial balance. Just type it in here because it's all the way at the bottom because they don't show the trial balance no respect. It should be at the top. This is one of the key reports. I'm going to go from 010125 022825. It's just like with my suggestions on how to improve business operations. No one listens, man. You get no respect around here. I tell you what, it's ridiculous. Okay, we're going to hit. We've got the balance sheet on top of the income statement. Balance sheet, asset, liabilities, equity. Assets go from the cash account down to the furniture and equipment. And then we've got the AP, the liability, and that's going to go down to the liabilities, go down to the payroll. And then we've got the equity, opening balance to owner's equity. We've got then the income statement, the billable income and so on, minus the expenses, and then the other income and other expenses at the bottom. Remembering that this February number represents the year-to-date data rather than the 1 month for the income statement because it closes out on a yearly basis, not on a monthly basis when you do automatic closing with the help and use of the QuickBooks system. If your numbers tie out to these numbers, great. If they do not, you might check your January numbers. Did your January numbers tie out? If they do, then you know it's a February problem at least. And if your February numbers don't tie out when your January numbers do, try increasing the date range. It's often a date issue. If there is a change from the date range, drill down on that number, get to the source document, put the proper date in between, most likely the month of February 2025, see if that fixes it. If not, we will do some data reports at the end of the first month of data or second month of data input, at which point you can check your numbers possibly to that.